In this particular case study we're going to look at today, this is a very valuable strategy, and we're going to try to answer this question, is this right for you? Now, before we dive into the case study, we are going to start with some of the basics, and with that, I'm going to go ahead and hand it over to Drew Niederer to start our webinar today.
Thank you, Chris. I appreciate the introduction. So as Chris mentioned, before we dive into that case study, we're going to start with Roth conversion basics, okay? I know we have a lot of people joining us this morning. Some people, they may be very familiar with what a Roth conversion is. Others may be less familiar. So we'll talk through what actually is a Roth conversion, and then we will apply that to an example, this case study. I think it's kind of fun. So you'll get to meet our case study participant here shortly. And then we'll look, as you're thinking through, is this appropriate for myself? We'll look through some characteristics for individuals where it might make a good argument for a Roth conversion, and then others not so much. It's not a one-size-fits-all approach, certainly. So we will certainly dive into that. Then we'll talk through a few gotchas, so these complicating factors. And then we will finish up with some questions and answers. And I know that's something, there's a Q&A button to submit your questions throughout this session. And so be sure to take advantage of that. And then we will finish up with that. We may even have a few questions sprinkled in as we work through today's webinar. So let's dive right in and talk through, all right, what is a Roth conversion, okay? So just like the name suggests, what we are essentially doing is we're converting something. And what we're converting is a tax-deferred account. That's kind of a mouthful, but if you're on this call, there's a decent chance you would have a tax-deferred account, whether it's through saving for retirement or your employer. And most often those show up as either traditional IRAs or rollover IRAs. 401ks are another very common example. Could be a 403b, thrift savings plan. There's a number of tax-deferred accounts, but ultimately we're taking one of these tax-deferred accounts and we're converting it, or a portion of it, to a Roth, an account that's titled as a Roth account. So most commonly that's going to be a Roth IRA. Could even be a Roth 401k. But I'll just show you the most basic example, though, of what this is. And so, again, just in its most basic form, when you see this happen, most commonly it's moving some traditional IRA dollars into a Roth IRA, okay? And that's it. Now, there's a lot of decision-making that goes into doing one of these very well. And so we're going to be talking through, like, what's the purpose of this, okay? And ultimately what we're trying to do is we're choosing in this conversion, we're actually electing to pay taxes today or whenever this conversion happens. And it might sound a little weird to voluntarily pay taxes, but the ultimate goal is to reduce future taxation down the road, okay? And that can be really, really powerful. So let's look at a case study here. And I know myself included, it's one of the best ways of kind of seeing how one of these works. And then we'll show how do we quantify this. So let's meet our case study participant, Marty McFly, or Martin McFly, technically. He goes by Marty. Marty is 66 years old. And he's actually retiring, just to keep things simple. He's going to be retiring at the end of the year. So, and just like most folks today, as Marty has been saving, predominantly he's been saving in Marty's employer's 401k, okay? And so you can see that's his largest investment that he holds, $1.6 million, okay? So it's grown over his whole working career. He also has a smaller Roth IRA, okay? By the way, to do a Roth conversion, you actually don't need to start with anything in a Roth account. Now, a Roth will come into play later, but that can be opened after retirement. I just want to make sure we clear that up before we're too far down the road for those asking. And then lastly, he has a number of bank accounts and other taxable investments. So think like brokerage accounts. That adds up to be about $200,000. Okay. And so as he's anticipating retirement next year, he expects to spend a pretty modest $60,000 per year in retirement. Okay. And by the way, Marty, he has two children, and this kind of may seem like a weird fact to include, but he has two children, and they're both named as the beneficiaries on his 401k, this large account that he has. And so we'll get to why that's important later, but let's just file that away. Okay. So we're going to be advancing to another screen, and this screen is part of our planning software that we use. And it really helps us anticipate current and future tax expectations. Okay, so I'm going to go ahead and click over there. I'll show you what I'm talking about. And so what we're looking at here is the chart is designed to ultimately help us identify opportunities for Roth conversions. And I think as you're thinking about it yourself, it can help illustrate, when does this make sense? Okay. So each bar, we have a series of blue bars. You can see these vertical bars, one in 2024. And those are by the way, those are the years. So starting in 2024, and then later on in 2031, you see more bars appear. That's representing taxable income, not income, but taxable income. Okay. And that's important. Well, we may circle back to that here later. And then each line, you'll see there's these lines here. I'll kind of highlight this bright green line. These are tax floors. So you may be familiar that there's tax brackets. When you file your taxes, someone might ask, what tax bracket are you in? Are you in the 22% or the 24% or the 12%? And so each line is representing what bracket you find yourself in. And so you'll see here, just to kind of show you this last year of work for Marty, right here, he is in the 24% bracket, okay? That's just because he has earned income, his salary. As a single filer, he has over $100,000 of income just based off of kind of this final year of work for him. And then later on, he actually does not have any income here in these next few years, which might seem a little odd, but I'll be honest, we see this often. You have someone, they have these bank account dollars that they could live off in those early years of retirement. It's a big temptation to just pull from those. It's going to have very little taxable impact to you. And so that's what Marty's doing here. That's why, if you remember, he has this $200,000 account that essentially he's living off of. And he also has some Social Security earnings as well. And so that's kind of that's funding that retirement spend need that he has. But then what happens here is kind of interesting. In 2031, I'm going to circle that right here. Marty has what's called a required minimum distribution that comes into play. So if you remember, he has this large 401k that he's been saving for his entire working career. Let's pause real quick. We're going to talk through a little bit what is actually a required minimum distribution. If you're not familiar, some people on this webinar may be familiar with these required minimum distributions, but let's just kind of discuss that briefly, because this is almost universally applicable to most people retiring, where Roth conversion is applicable. So as the name suggests, required minimum distribution, this is essentially it's a forced distribution. The IRS has a mandated table that they calculate based off of your age, and they apply to your tax deferred accounts. So in Marty's case, it's his 401k, could be a traditional IRA, could be any other of these tax deferred accounts. Again, pick 403B, thrift savings plan, SEP IRA, simple IRA, all these various, but most commonly 401k, traditional IRA. Okay, what can be tricky with these is that those distributions, in its name, it's tax deferred. So in those working years, tax was never paid on those dollars. But IRS has this pesky RMD that comes into play because they want to start earning some tax revenue off of it. So there's this forced distribution, and those are taxed as if you were working and earning those dollars. Okay. And by the way, this is kind of interesting. Recently, required minimum distribution ages have been pushed back. They've kind of been drifting backwards over the last few years. And right now it's 73 or 75, depending on your date of birth. In Marty's case, it's 73. So let's go back to our chart here. So this is the year Marty turned 73. And he has his first required minimum distribution. That's why there's this taxable income. That's that first bar. And every year after that, Marty continues to have these required minimum distributions. Unfortunately, they don't stop. Once you start, they essentially will continue on unless you completely draw it on your account. And what's interesting about required minimum distributions is even if your account balance stays the same, as you age, the amount you need to take out of the account each year will increase, okay? That's that age factor, okay? And that's this is very quantifiable, and that's what's happened to Marty here. So you can see that he starts out in the 22% bracket this year. And by the time he's into his 90s or late 80s, actually pretty rapidly, he's already into that 24% bracket here. And so in all these years into the future, he has, again, he's being taxed in that 24% bracket. And this is an opportunity for us. So let's show what a Roth conversion scenario looks like, okay? We're going to show the same chart, but now we have these yellow bars show up. And so what these yellow bars are illustrating are these Roth conversions. The yellow bar is that voluntary tax, essentially, that's being paid. And what's happening, the mechanics behind it is that Marty's moving his 401k to his Roth IRA. And so you can see that the tallest bars are before his required minimum distribution. See them right here? And the key is that as he's converting, he's only converting up to the top of, in this case, the 24% bracket. And again, this is kind of case by case. It depends on your spending assumptions and how many dollars you're starting with in these tax deferred accounts. So that's what's happening here. And you'll notice, let me toggle back to the original scenario. He has significant dollars that are being taxed at that 24% rate, okay? By converting, he has no dollars being taxed at the 24% rate. They all stay underneath that 12%, or that 22% ceiling, essentially. And what ends up happening, if we're to kind of look at the bottom here, so his cumulative tax bill falls by about $500,000 because later on in retirement, should he do nothing, he will be taxed like very aggressively on those forced distributions, those required minimum distributions. The other thing that's kind of interesting is that even though we're paying all this voluntary tax early on, the amount of dollars left over at the end, I'm going to circle on the bottom right here, his portfolio actually goes up by $172,000 just by doing this conversion. Now, what's important is that these dollars, they're not the same dollars either, because now most of them reside in the Roth account because he's every year taken a little bit out of the 401k, moved it to the Roth, moved it to the Roth, moved it to the Roth each year. And so that's going to have a big effect even over just Marty's lifetime. Okay. So let's look though beyond just Marty's life. This is going to have a significantly bigger impact even to the next generation, his two children. If you remember, his children were the beneficiaries on the 401k. So we've estimated here that given those kind of base assumptions that we listed, and he also owns a house and that sort of thing, but Marty's estate is a little over $10 million. So that's this top blue bar. But should the kids expect to inherit that much? Certainly not, because of, unfortunately, there's this pesky red bar here. That's the taxes and expenses. And you might say, well, how does that work? There's this other thing. So required minimum distributions, we've already talked about that a little bit for the account owner. There's also required minimum distributions for the next generation, generation 2. If you remember, these are going to be Marty's 2 kids. So let's pause right there and talk about what's changed recently in inherited required minimum distributions. So just like regular old required minimum distributions, they're forced distributions, but now out of this inherited tax deferred account. So whether or not the kids inherit as an inherited IRA or an inherited 401k, they themselves also have to take these forced distributions. And those are also taxed as ordinary income. So you can imagine, you're inheriting roughly $10 million. Let's split that 2 ways to each child. So maybe 500,000, 5 million each. If you were to divide that, and this is where the math really can get a little crazy here, but the required minimum distributions, what's unique about inherited is that you're not just taking it over your lifetime anymore. Since 2020, those who pass away and leave them to non-spouses, they had to distribute over just 10 years. So it's abbreviated, it's compressed, these distributions. And so you can imagine if you're inheriting $5 million as child 1, then even if you spread it out as flat as possible over 10 years, that's a $500,000 distribution each year. And they might still be working. So that could thrust them into one of these very high tax brackets. And so when you're thinking through a conversion, certainly there's benefit many times to the owner, but significant benefit to the children. So let's hop back to our chart here just to look at what we were looking at. Okay, so ultimately, heirs are inheriting after they've paid this tax bill we've kind of estimated $9.1 million. Okay, so let's look at the conversion. Again, this is the non-conversion scenario. And Chris, I see your hands up. Before I proceed, yes. Any questions? Chris, I think you're muted. There you go.
Muted. We had a really good question, kind of relevant to the start of this slide. So Marty had about $2 million to start this plan, and now we're looking at a estate of close to $10 million.
Yes. Yep.
What was the time horizon and the rate of return that kind of got us from 2 to 10?
Yeah, great question. So we're assuming, a moderately aggressive portfolio, so about an 8% rate of return. And if you remember, the reason that these and he has a home, so we didn't list that out, but has a moderate home as well. So that's also included in his estate. And so, but yeah, the investments are growing at a very reasonable rate of return. And if you remember, he's living fairly frugally in Marty's case. And it's not like, even if you were spending more, this conversion still could be beneficial. But in this case, this is just kind of what we're working with. Yep.
And how long was that time horizon? We went from 2024 until what year?
Until Marty. So Marty's 64, and we're going through him turning 95. So we stretched it out over the next
31 years.
Yep, 31 years.
So 8% over 31 years got us from 2 to 10 is that one. Yep. Excellent. Thank you.
Yep, no problem. All right, let's continue on. And by the way, we're calculating taxes along the way, because remember, those brokerage dollars, there's tax involved there. There's tax involved on the required minimum distributions. And so there's a lot happening in the background. We had not gone through all the intricacies of how we're calculating that, but just generally speaking, yes, Chris, that's what's going on. Okay, so this is the conversion scenario. So let's hop back here. I got a little ahead of myself. So non-conversion scenario, Marty's got 9.1 that are landing with the children. Conversion scenario, it's a $788,000 difference, okay? And even though Marty's estate is not exactly $788,000 more, it's more, But the biggest difference is the taxes and expenses right here. So $330,000. And the reason that's happening is that if he were to not, he only has in this scenario about $1 million left. Of that $10 million, only about $1 million is left in his 401k. So not a whole lot. Most of it has been shifted into that Roth IRA, which from a beneficiary standpoint is certainly preferable. And just to compare again, this is what that looks like in the non-conversion scenario. So you can see that tax bill is just tremendously different. Okay, so let me take off my mark. All right, so let's talk through just fundamentally who are good candidates for Roth conversions and then who are bad candidates. And so we'll start with the good candidates. And at the most, when we boil it down to the most basic level, it's those who expect to be in a higher bracket later on, okay? So in Marty's case, if you remember, that first year of retirement, he will, in year 2025, he's going to be in a very low bracket, actually a 0% bracket. But by the time required minimum distributions start, he will be in a higher bracket. And then later on, he's going to be in a very high bracket. And so he's a good candidate because of that. Now, what are the causes? We've already talked at length at required minimum distributions. Again, they're pretty applicable to most people who have some sort of tax deferred account. There's some other reasons too that you might find yourself in a higher bracket. It could be a higher future tax rate. And so if I go back here, let me just skip back really quick. I'm just going to show you what we have here. You'll notice at the bottom here, these floors, my circle isn't the greatest, but you see the point. There's multiple numbers listed on these. So it's like 10/10, 12/15, 22/25, and so on. Those slashes represent in 2026, as current tax law sits, we are reverting back to higher rates, the pre-2017 rates. And so we're accounting for that. So that's a future, as things stand now, and it's hard to tell exactly what Congress will do between now and then, but rates will go up. And so, and it's even harder, frankly, to forecast between now and 2050, for example, but that's something to be aware of. And so by converting, you're essentially prepaying tax now, and you're insulating yourself from a future tax increase. Chris, I see you have a question.
Yeah, there were a few questions that I think this slide will be really helpful for. The first one is, how many years is Marty doing Roth conversions?
Great question. So Marty is actually doing, in this scenario, he's doing them through age 20, through the end of his life, actually age 99 or 95 rather. Now, that doesn't mean that he would, every year he continues to convert. As he's in that later stage of conversion, it's more of one of these things where if this were happening in reality, okay, this is where it's kind of one of those, it's a case-by-case scenario. We would really be looking at what are his children's earnings situation, and does it make sense for him to continue converting in those latter years? If his kids are, say, they're not working or they're making a very modest income in a significantly lower bracket. But we're actually showing a conversion every year, because even with his required minimum distributions, because we got a head start early on, he never converts above that 22% ceiling. He's always converting in that 22% ceiling. But you can see the lion's share, most of the heavy lifting of these conversions is happening, and you'll see it's these tallest yellow bars here, these early years of retirement before the RMDs have fully kicked in. Okay, so that might be helpful as you're thinking through this. Those are always going to be the most impactful years, but it doesn't mean you cannot convert in those latter years. Then it's more of like an estate question.
Yeah. So I'll ask one more where this slide will thing up, and then there's a lot of fantastic questions in the chat. I'm going to pause on most of those till we get to the end, but we will do those in the Q&A. We'll get to as many as we can. The question that I think this slide would be really helpful for, originally there was no taxable income, but he is taking Social Security.
Yeah.
When he does this Roth conversion, what happens to the Social Security taxes? And does he stay in a 0% tax bracket with the Social Security?
Great question. So let me hop back to the previous slide. I can show you the unconversion scenario. So what's happening here is that Social Security is, and we're going to get here, it's a tripping point as you're thinking through the conversion. Because what's unique about Social Security is that it's taxed at varying rates depending on income. So in this base case, even though Marty is receiving Social Security income, he's not paying tax on that income because he's essentially taking tax-free distributions from his bank accounts, if that makes sense. Later on, you'll see that so there's no blue bars here, if you'll notice. Now, there's very small blue bars. That's his Social Security showing up because the conversion actually changed those dollars from not being taxed to being taxed. And the analysis suggests that it's worth it in this case for him. For some people, it's not, though. I'll be honest. And so this really can be particularly tricky for people converting in that 12% bracket, because that's where if you're below the 12% bracket or inside the 12% bracket, oftentimes your Social Security could be either fully taxed, well, tax up to 85%, that's kind of the high water mark, or tax as little as zero. So in Marty's case, he was being taxed at zero.
Excellent, thank you.
Good deal. So let's keep going through some scenarios, good and bad candidates for this. So we spoke to required minimum distributions. We spoke to those who are concerned about higher tax rates. Let's talk about survivorship concerns. So in this scenario, Marty was single. He was a single tax filer as well. Let's change things up a little bit. Let's pretend he's married to Jennifer, and same asset level, everything else. His brackets are going to look very different. So let's say Marty's married filing jointly now. His brackets are essentially going to be double of what they are now. So now the conversion's even more favorable in many ways while he's living, because he has more room to convert while staying in these lower brackets. Okay. And conversely, if Marty were to die and Jennifer continues living, her brackets would then fall back to these single filer brackets. And there's this risk potentially, if should one significantly earlier predecease the other, where if you remember required minimum distributions, they're still going to apply to Jennifer. Essentially, she's going to inherit his IRA. They're going to be absorbed into her IRA, and she'll continue with these required minimum distributions. And so she'll find herself in the same scenario as Marty here, paying higher find herself in a higher bracket when there could have been a very cheap Roth conversion earlier on when they were both living. So it can help with some of these longevity concerns, these survivorship concerns. And then the last, we certainly want to talk through this as well, but the last cause for potential like higher future brackets is this legacy question. And let's flip this around a little bit. Let's say, this slide actually probably does a little bit better job of explaining it. This bottom scenario here, okay? Those who expect to gift IRAs to charity. Let's talk about how that plays out. Let's say Marty has no children, or for whatever reason doesn't want to leave anything to his children out of his IRAs, or 401k in his case. If he titles a beneficiary as a charity as a beneficiary, then Marty's not going to pay, that charity will not pay tax on that distribution at his death. And so if you were to, let's say, convert everything over and there's nothing left in the IRA, then in a way he over converted, should have left some dollars in there so that he didn't pay tax and the charity doesn't pay tax. And so you have to be really thoughtful if you're planning on leaving a significant portion of the IRA to a charity, then that's something that we would want to kind of pump the brakes on and look at. And this even can extend to your lifetime. So require minimum distributions. Another thing that we can do to help reduce those are something called qualified charitable distributions as well. So essentially directly giving out of your IRA to charity. And that can also help blunt their RMD concern. So those who are highly charitable, who are giving a majority of their RMD to charity and then a majority of the account to charity, it certainly gives us pause on this conversion. Okay. And then lastly, some other kind of people who may be poor candidates for conversion. Those who are currently employed and are in these like higher salaried positions, just like in Marty's case, he's working in this higher bracket. And so it doesn't make a lot of sense to go ahead and start converting while still working because there's very little benefit in those earlier years. And Chris, I see that you have a question here.
Yeah, I just was going to mention we're at about 34 minutes right now.
Okay.
And what I wanted to mention is we have several questions that are related to that last slide, some of the complicating factors.
Okay.
So maybe we could pop over to that slide, and then we'll dive into the Q&A once we kind of cruise through that, because there's a lot of great questions in the chat as well that I want to make sure we respect everyone's time and are able to get to. Yeah, go ahead.
Perfect. So let's talk through some other complicating factors. We've already talked about one here, Chris. Good question on the Social Security. So as you remember, Social Security is taxed at variable rates depending on income. So that's a complicating factor, particularly for those doing smaller conversions. Those who are between the 0 and the 12% bracket, like the top of the 12% bracket, a conversion might have this ghost taxation effect where it costs you more than 12%, like to do the Roth conversion, because now some of your Social Security that was being taxed, not being taxed at all, is now subject to taxation. And it has this outsized effect on the cost of the conversion. Okay. Some other complicating factors for those who are, we kind of have some for those in here that are below 65 and others that are above 65. For those who are above 65, let's talk about this one. We'll take it from the top. But the pesky income-related monthly adjustment, that's relating to the yes.
Yeah, I'll just mention we had several questions related to IRMAA. So if you want to unpack that one a little bit more, I think that would be a really great use of time.
Absolutely. So just a quick refresher for those who are unfamiliar with IRMAA. As current law stands right now, depending on what your income is, and all of these complicating factors are based off of a change in income. As income goes up in retirement, there are certain thresholds where all of a sudden you may be paying $75 more per month for Medicare. Now, it's often the case, depending on that conversion, the last thing we want to do is to convert just $1 above that next threshold, okay? Because that $1 of conversion is going to cost you $75 a month or something like that. We would avoid that. And so one of the things, as you're tailoring this to someone or as you're thinking through it yourself, you would want to weigh, does that additional cost to Medicare outweigh the benefit to the conversion? And so what that means is typically when you're converting, you want to convert up to that next, but not above, but close to the next IRMAA threshold. That way you're getting the most bang for your buck on the conversion. And again, avoiding slightly over converting and then essentially having to pay significantly more on Medicare for that year. And you won't realize that in the year that you make the mistake, so to speak. You'll pay that effectively 2 years down the road. And so let's say you make a mistake this year, 2024, you'll pay for it on your 2026 your Social Security will essentially be, for most people, withheld more, aka your Medicare is going to cost more 2 years down the road. And so it's something you have to weigh with the conversion. In Marty's case, you could see the millions, like the $788,000 benefit, it's worth it for him. But for others, it's not, particularly if you're really close to one of those IRMAA thresholds. So that's a big one. Certainly, you'd want to be thoughtful in that conversion, whether or not you're going to trigger that and how close you are to triggering that. Some other things as well. Let's just stay on the topic of healthcare real quick. These are for our below 65 people who perhaps they are on a marketplace healthcare plan. Maybe they're retired or their employer doesn't offer health insurance and they're receiving a premium tax credit. That tax credit's going to go away as your income goes up. So you got to think about that. And the rough math of it, and again, this isn't perfect, but it's roughly an 8.5% reduction of benefit. So think about a 12% conversion could be as much as a 20.5% conversion, depending on how much you're qualifying for that premium tax credit. Again, it's a little complicated. It's case by case. It depends whether or not you're getting a marketplace plan, how much you're paying for that plan, and so forth. But that's another complicating factor, something to think about for our folks below 65. And then this is a little bit of a smaller one, but certainly worth mentioning. Net investment income tax. This is a surcharge to capital gains taxes. It's 3.8%. People whose incomes is above a certain amount, they'll have to pay more on capital gains. This isn't related to IRA distributions, but it's for other taxable investments that you're realizing a gain. And this is for those having larger conversions typically, or in those higher brackets to start with. NIT is something we would also want to be aware of, and potentially maybe the year before conversion, realizing any gains, paying it in a lower bracket prior to the conversion. So those are just a few other complicating factors. There's others as well, but all these are associated with anytime you artificially, and even if it's on the short-term side, increase your taxable income, things happen, okay? And any of these could happen. It really depends on where you find yourself on the income spectrum. And conversely, Marty may be triggered these IRMA brackets had he not converted because his taxable income is so high later in retirement. And so it's really one of these case-by-case type things. But certainly like complicating factors as we're considering the conversion. It really depends on where you find yourself on the income spectrum. So I'll open it up to some more questions, Chris. So any other questions you're seeing coming up or any themes?
We do, yeah. We have a lot of great questions. One thing I was going to mention, some of the questions in chat are really specific to a unique situation. We definitely want to help with those. You can see on the screen here a way to schedule a free consultation for a strategy session that's specific to your unique situation. If you're interested, you can book one of those and we can walk through your numbers and your situation. It's a lot more helpful sometimes than speaking in generalities. So some of the really specific questions, I would definitely recommend taking that route. You can also book in Calendly in the chat. So if you click on the chat bubble at the bottom, you can book there. So a couple really good questions. How do you figure out how much to convert for Marty in a single year? What are you thinking through?
Yeah, so when we're approaching it, we have this software that we're using that's forecasting essentially the rest of Marty's life, but then you really want to get very precise in each year of that conversion. So we actually use more of a tax software, frankly, to get a good estimate of what we expect taxable income, that's starting base to be, because that's kind of where we start. First, you need to start broadly to understand, hey, what tax rates am I in jeopardy of finding myself in later in retirement? And if it's significantly higher than where you are today, then it's a matter of essentially getting as close to an income estimate as possible, and then knowing what bracket you want to convert up to. So in Marty's case, we're converting up to, but not above the 22% bracket. And so that's one of those things where we just want to have a really good understanding of kind of income expectations. And normally we'll start with last year's tax return. So that might be top of mind for folks right now. So we'll start with that and then adjust for any changes that we would expect this year. And then we'll model out, okay, how much conversion does it take to hit the top of that bracket that we want to be in, or that IRMA bracket, kind of depending on where we are there.
Excellent. Thank you for that. Another question was in terms of doing the conversion. So we're moving money from these pre-tax accounts over to a Roth. Can you
Yes.
move over stocks as opposed to cash when you're doing that conversion or an in-kind transfer?
Yeah, so great question. Kind of depends on what custodian, so who's custodying those assets. So, we work with a few custodians here, and they will allow what's called an in-kind conversion. And so what that means is you're not, for those who are unfamiliar with the terminology, instead of converting a dollar amount, you're converting a share. And essentially it's based off of the fair market value at the time it transfers from that traditional IRA or 401k. Again, normally these are happening in traditional IRAs. It's most 401ks, unless you're going into a Roth 401k, you can't transfer those shares over. But yeah, you certainly can. Now, just be mindful of if you're assuming you're not in the 0% bracket, there's going to be a small tax liability there that ideally we're paying out of that brokerage account that Marty has. That way you're getting a dollar for dollar conversion. So, yeah.
Excellent. Thank you. Another good question. Where's the money come from to pay taxes on the conversion? And then is there any strategies revolving around that could be advantageous?
Great question. So Marty kind of worked out well because he did have some brokerage dollars, and it's hard to say exactly how he came about that $200,000. It could have been an inheritance from a parent. It could have been just some savings that over time have increased in value. But ideally, best practice on a conversion is to get to convert dollar for dollar when possible from a traditional IRA or from that 401k in Marty's case to the Roth account, and then pay the tax. Because again, unless you're converting in the 0% tax bracket, there's going to be a small tax cost to this, and bringing that in from an outside source. That way you're getting effectively, and the alternative is to withhold on the conversion. And that's, while not ideal, in Marty's case, it still would be beneficial because we know we're essentially converting and making use of these lower brackets to forego paying in this higher bracket later. But I'd rather, frankly, if you have brokerage dollars or some bank dollars or something that's available, it's better to have it in a Roth account ultimately than in a brokerage account, unless there's some sort of weird timing issue where you expect to need a lot of money in a short period of time, because there is a 5-year, and we didn't really talk about this. It's another complicating factor, but in Marty's case, he's leaving this Roth asset to his kids. But let's say for whatever reason he needs to take a distribution, then there is a 5-year window that exists on these conversion. Ideally, though, frankly, to maximize this, we're kind of thinking of the Roth dollars as a legacy transfer vehicle. So yeah, hopefully that's helpful.
Yeah, super helpful. So we are at about 47 minutes. We're a little bit past the time we had originally slotted. I'm going to do 2 more questions. I know we're not going to be able to get to all of them, and I apologize for that. Again, feel free to schedule that strategy session so we can help with your specific scenario. But we're going to do 2 more questions. One was, if someone is currently invested in mutual funds, stocks, bonds, whatever, in their 403B,
Okay.
what options are available when it gets converted to a Roth in terms of what they can invest in? Can they
Great
stay in
question.
the same type of investments?
Yeah, so it depends a little bit on that 403B plan. Theoretically, if there's some 403Bs may have a Roth option associated with them. But most often when someone's doing conversion, they're doing what's called a partial conversion into, typically it's a Roth IRA account. And the advantage to a Roth account rather than these kind of employer-based plans is that you have a wider investment pool to invest in. So if you're with one of these larger custodians, there's instead of being limited to maybe 10 or 15 investments in that 403B, you may have thousands of potential investments, from individual stocks to U.S. Treasuries to individual other bonds and all sorts of mutual funds, ETFs, all sorts of things. So it's going to open up a lot of flexibility if it does go into a Roth IRA ultimately. But one caveat with that is, and there's a few, just to be clear, but normally you have to be retired unless your plan offers what's called an in-service distribution. So it's just something to be aware of.
Yeah, we'll do one last question. Again, apologies we couldn't get to all of them. They're all really, really good questions, and appreciate all the active participation. Last one we'll do. So you had mentioned this 5-year rule, Drew, after a Roth conversion occurs.
Yeah.
With that, if you were to try to pull monies out, is that 5-year apply to the converted amount or only the gain? Like, how does that exactly work, and what's going on there?
Yeah, so there's kind of two different clocks that are involved on this 5-year concept. The first is the gain, which is a separate concept from the conversion amount. And so you can actually start the clock on the gain very easily by just having the Roth account essentially open for 5 years. And it's pretty complicated. Certainly want to talk to someone who's your CPA and that sort of thing. But typically the way that works is that even if you just were to do a small conversion early on, and maybe it's not ideal, you can actually start that conversion clock or that 5-year clock on the gain portion. From there, there's a separate clock that starts with each conversion. So as you convert, that unique conversion will have its own 5-year window. And again, best practice though is that hopefully these are kind of our favorite dollars. As soon as they're in the Roth account, they're our favorite. They're the best dollars because they grow tax-free. And ideally, we're not spending those down. We're holding on to them for maybe there's some huge need later in retirement. Maybe it's like an entrance fee to a retirement community, or perhaps it's this legacy transfer in Marty's case, which is really ideal for him. But yes, there is a 5-year clock, certainly. So certainly would want to kind of keep that in mind from a distribution standpoint. Yep.
Excellent. Drew, thank you so much. Really appreciate it. Extremely informative for me, as always. Thank you, everyone, for attending. Again, I'm sorry we couldn't get to all the questions. We do look forward to speaking with you, those of you that have scheduled that strategy session, and we hope that this was valuable for you and you're able to have some actionable stuff out of this that will create value for your retirement. So thank you guys so much, and we look forward to speaking with some of you here in the near future. Thank you.